Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial conditions.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Monday, January 12th, USDA WASDE day, and if you didn't know it, you could probably guess it by looking at some of today's grain charts. We've got the March corn contract pulled up here, and we'll just jump right into it. Ugly, ugly day. Coming into this morning, we were trading a little bit higher, really across the board. Corn, soybeans, and wheat all showing a little bit of firmness. But boy, as soon as that report was released, it was like a trap door opened up. As you can see here on the March corn contract, break and close below this little bit of a trend line support really accelerated the selling. And I don't think that this was all technical in nature. Obviously, we got a report, so there was a fundamental catalyst behind the breakdown. And when you're digging through the USDA report from today and try to find a silver lining, good luck. Let me know if you find anything. Unfortunately, there really wasn't a sliver of good news in today's report. We had the corn yield 186.5. That was only up a half a bushel from the prior report, but the average analyst estimate was 184 bushels. So when you're trading these markets, you want to trade the expectations, essentially. So everybody was looking for a decrease in yield to the tune of about 2 bushels. Instead, we got a half bushel increase. So bearishness there. We had harvested acres increased as well, 91.25 million acres. The amount of acres that we added really since the first report earlier in the year has just been astonishing that we've got all those acres, and then on top of that, we've got the increased yield. So a bunch of headwinds there, putting total production just over 17 billion bushels. So obviously, that is a huge headwind for the market. We saw the technical breakdown today. The big question is, can the market rebound from here? Or are we going to see more selling and take us down towards those August contract lows, which come in near 410 for this March corn contract? If I was just kind of looking at this chart, I'd say, wow, that's probably overdone in the short term. But in that report, again, it was just so bearish, and funds right now positioned relatively neutral, where they've got powder to add on the back of that bearish number. Potentially we get a rebound from here and can grind back higher, but to what point is going to be the big question. Is the upside going to be limited here? Right now, as we're sitting here, I would say probably yes. The big upside level, we talked about the downside level from here, that 410 level from those contract lows in August. The upside objective, the bulls want to look for is a spot 425, a little bit of a headwind resistance pocket. The bigger spot's going to be this breakdown point, a potential retracement there, which I really wouldn't be surprised to see the market get back up there eventually to the breakdown point. Maybe not the March contract, but maybe in some of the deferred contracts. The big question is, do we trade down to 410 before we can really find our footing and carve out a little bit of low? That's the big question. So the next couple days, I think, are going to be very telling for price action going forward. As always, be sure to manage your risk appropriately. A lot of times these things can move further and faster than you think. Now, over on the soybean side, it was more of a ho-hum report. The average yield estimate there, 52.7, so that was going to be a decrease of 0.3 of a bushel. Instead, the USDA left that unchanged at 53. Harvested acres, really not a whole lot of change there. Overall production, not a whole lot of change there. Maybe a slightly bearish tone to it, but all in all, I would say a ho-hum neutral report for the soybean market. But the prices still quite a bit lower. We rounded out here, failed to get out above the 200 and the 20-day moving average, and closed back below this whole trend line support level, which is not a good look on the chart. There is some support down here in the 1030s. That's going to be the must-hold line in the sand for the bull camp. A break and close below there, and you're looking at $10. I wouldn't be surprised to see the market maybe hold a little bit more firm. Talking with clients really throughout today's trade, if you want to be bullish anything in the grain markets, it almost looks like that new crop November 26 contract is going to be where you want to park your optimism. Wouldn't be surprised to see some premium come into that market and try to buy some acres as we kind of get the ball rolling past this report and start talking about what's going to go in the ground here this spring. So that's what we're looking at for the soybean market. Then over to the wheat market, unfortunately, not a whole lot of good news to write home about there either. We got up towards this resistance pocket early in the trade, traded to the highest levels really since about middle of last December, and obviously rejected that. Just not a lot of good news going on in the grains. Big technical breakdown? No, not necessarily. Basically right back in the middle of the range from the last month. So bulls still have some work to do. We've talked about this in the past couple videos for the wheat market. If you want to be a buyer, I think it's almost prudent to be a buyer on strength. We talked about that being a breakout above this resistance pocket near 530. So if we get out above 530, potentially that would spur some additional momentum to the upside. Not only was that a big technical level as far as support and a breakdown point goes, but you also got the 100 and the 50-day moving averages trending lower, which coincide there as well. So potentially, if we can get out above there, that would be the catalyst to spur it. On the downside, obviously, you're looking at these recent contract lows near 502. $5, psychologically significant. Below there, maybe another 10, 15 cents a downside if we can't hold that. So again, know where your limits are and where your stops are on these markets. I think we're going to see volatility probably pick up here this year. Looking at the average trading ranges over the last couple of weeks, we've really shrunk quite a bit across all these markets. So volatility has been coming in. I wouldn't be surprised to see that start to carve out a low here as we, again, start talking about what's going to go in the ground this spring. Now, over on the cattle side of things, it was ho-hum day as well. Lower close last week, but we tested and held this breakout point from January 2nd. That was the first trading day of the month. So overall, pretty constructive. We talked about this on RFD TV this morning. The fact that we were able to hold that, I think, keeps the bulls in advantage of the technical chart. But how much more upside is left from here is going to be the big question. I don't know that a whole lot is going to be left. I would say if you get back towards the upper end of last week's range, that would be an opportunity for hedgers or potentially bearish speculators to look at taking a position. So for this February live cattle contract, that's going to be near 237.5. If we don't make it up there and we eventually, break back below this box, again, conversely, this is like the opposite of wheat. If we broke down, you'd almost want to be a seller on strength. So those are the levels to watch for live cattle, feeder cattle. Similar type of chart setup here, pulled back a little bit last week, but really held the low end of the range from last week. We didn't quite get to the breakout point from January 2nd, so there might be a little bit more downside risk in the feeders if we break and close below that 353.5. So that's going to be something to take note. And then over on the lean hogs, fairly decent trade, pulled back. You probably don't want to see that, but overall still constructive, marking higher lows as we go. We tested and held the 20-day moving average, which is great. We also tested this box here, which we've outlined as a pretty big inflection point for the market, really over the course of the last year. So the fact that we were able to defend $90 and bounce a little bit off of that is encouraging. For the next leg higher, bulls want to see, obviously, not only support hold, but take out these recent highs near 92. If we can do that, we think that the market could potentially retest these highs from back in September. So that's what we're looking at for the grain and livestock markets. And over on the outside market, something that's caught our eyes, the crude oil market was extremely resilient last week. Had a probably reason to keep selling off last week on the back of the Venezuela news, but rebounded. Closed out above trendline resistance last week and saw some follow through in today's trade, which I thought was encouraging. You think back to the Sunday night trade, we saw a risk-off environment in the equities, S&P, NASDAQ, everything getting pretty hard on the back of the Jerome Powell headlines. Crude oil kind of held its own. I would have thought that we'd see more of a risk-off trade sentiment reverberate into the crude oil market. We have not seen that. I think we can continue to carve out higher lows and higher highs. The big inflection point for this market is going to come in near 61.5 above that, and I think that's where things could start to get even more exciting. So something to keep on your radar there. Again, talking about buying on momentum and buying on strength, this is going to be a market to keep on your radar. So that's what we're looking at to start the week. If you've got any questions at all, don't hesitate to reach out. We are ready, willing, and able to help. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.
Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition. All information, communications, publications, and reports, including the specific material used and distributed by Blue Line Futures LLC, shall be construed as or is in the nature of a solicitation for entering into a futures transaction. Blue Line Futures LLC does not employ research analysts or maintain a research department as defined in CFTC Regulation 1.71.